In this session, we will learn about two properties of financial assets, mean reversion and co-integration. Based on these properties, we will learn about the trading strategy called pairs trading. From there, we will examine the more general strategy called mean reversion trading. First, let's review some concepts. What's mean reversion? A mean reverting time series is one that tends to move back and forth around some constant value. When applying mean reversion to a single stock, we could check when the stock price deviates significantly from the mean. For example, we may see a stock decline significantly below its historical average. Assuming the stock will revert to its mean, we may buy the stock and anticipate that it will increase back to its original price. There is still the risk that the stock price does not return to its historical mean. For example, the stock may settle at its new lower value. Even worse, it might just keep declining. In practice, it's more common to apply mean reversion to a pair of stocks. Let's imagine that two companies are economically linked. By economically linked, I mean that they may be in the same line of business, may be operating in the same country, and may have similar types of products or customers. We can imagine that the stock prices of these two companies may also move up and down in a similar way. Since these companies move up together and down together, they appear to have a consistent relationship that we can expect will continue into the near future. So, when we see the prices of these two similar companies diverge significantly, we may make trading decisions based on the assumption that this divergence is temporary. The view of our trading strategy is that later in the future, the prices will settle back to their original relationship. We will examine these concepts in more detail in the next session. Let's look at mean reversion in detail. We can plot a stock price movement against its moving average. We tend to see that when the price increases or decreases significantly from its moving average, the price then reverts back towards its moving average. To describe a mean reverting process with some math, we will use what's called the drift and volatility model. To guide our understanding, we will imagine the stock movement as a boat that is floating passively in the ocean. The change in price of an asset over a period of time is the sum of a long-term average plus some randomness. This long-term average is called the drift term because it changes over time, but relatively slowly. Hence, the long-term average is like the ocean current that slowly and steadily carries the boat. The amount of drift depends upon the current price and the amount of time that has passed. The random part of the price change is called the volatility term. We can think of this volatility component as all the fish, dolphins, or even whales that bump into the boat. All of these little bumps move the boat in a more random path around it, stripped. The volatility term depends on the current price, a standard deviation, and the amount of time that passes. The standard deviation is small when the markets are calm, so it's likely encountering a small group of fish. The standard deviation may become large during a market crash. This would be like encountering a group of whales. With math, the drift and volatility model looks like this. The dp_t on the left represents the change in price over the time, t. The first term to the right of the equal sign, a, is the drift term. The drift term is made up of the current price, a constant average mu, and the change in time. The second term on the right is the volatility term. The volatility term is made up of the current price, a standard deviation sigma, a random noise factor epsilon, and the square root of the change in time. If this equation feels intimidating, don't worry. For now, just think about the boat drifting in the ocean, encountering fish, dolphins, and maybe even some tropical islands.